All right. Welcome, welcome everyone. Thank you for being here. And thank you for yeah, I know it's only December and I know 2026 is close, but not quite here yet. But the best time to start thinking about 2026 is yes, in 2025. And there are a lot of changes coming down the pike that one, you should be aware of, but two, we should be thinking about. And I'm thinking especially of tax changes. Obviously, there's things going on in the world, in the markets, things that's always in flux to an extent. But today, the game plan is that we're going to go through a, I was going to call it a list, and it is a list, but that makes it sound more boring than it is. But really impactful things that I think all of us should be thinking about. Now, not all of these are going to affect any one of you. In fact, you may find, ooh, okay, that one doesn't totally affect me, or that's not going to change too much for me. So, and that's totally fair. With this is a little bit of a catch-all kind of a thing, but what we're going to go over is important stuff that even if it doesn't affect you right now, could in the next few years. And specifically, obviously, next year. So thank you for being here. As always, if there are questions that come up along the way, feel free to put them right in the chat or the Q&A function, either one. If you do have the ability, if you want to ask a question that only I can see, so you're not just opening up a dialogue with the entire attendee list. That's fine. The Q&A function allows you to do that. And at the end, we'll have even more time for questions. So don't hesitate to put them in as they come up, and I will be paying attention as best I can. And Aaron, if I miss one, will hopefully interrupt me and flag me here. But we will also have time at the end for questions too. And just in case there are some people on here who don't know me, my name is Anthony Gerbi. Been a financial advisor with Stein Financial Group for over a decade now, and I know most of you know me, but there's always a few new people on each one of these, so I want to make sure I'm not skipping the introduction part. And it's not going to be hey, here's what your investments should look like in 2026 sort of a presentation. We do market stuff. We'll do another one in February next year. So there will be time for those discussions and kind of what the trends have been. This is more about things we should all be thinking about. And here's our agenda. Now, it's not again going to be, I hope, or I will do my very best to make it not as dry as, okay, well, let's look at your life and lifestyle updates and let's review your budget and let's do tax plan. I'm going to try to distill this into a take home point for all of you to actually act on. And if you'd like to play along, so to speak, there's no quiz or anything, but if you happen to have, your computer or a notepad in front of you, there will be a tip on many of these pages that's like, okay, here's everything I'm talking about distilled down into the one thing you can do right now or, relatively soon. So you'll see them as we go. Those are kind of the things you get to act on. Okay. I've gotten my preamble out of the way. Let's just dive in. What should we be thinking about as 2025 comes to a close and 2026 kicks off? So obviously, one of the first things, and I'm just going to go to the next page right away because this is just the header of it, is there anything that has changed for you? And I don't just mean, circumstantially necessarily, although that could be depending on what it is. But did you move? Did you retire? How has your family grown or subtracted in different ways, right? And that has impacts not just on working with somebody like me to help manage your finances, your investments, that also has impacts on what you want your will to look like. If you need a trust, maybe you have a trust that you don't need anymore. All those things. Don't forget, I talk about this when we do our estate planning webinar a little bit more in detail. And by the way, we just did one. If you want to find it, you can go to our YouTube channel and watch the replay of it. But what's often overlooked is life events that change. Oh, well, actually, my daughter it got a new job, and wow, it's a big upgrade from what she had, and she's doing fantastic, and I don't need to think about her financial needs in the same way that I used to. Well, that might have a ripple effect, right? And those are the things that get overlooked until it's, years down the road. And you're like, oh, shoot. Yeah, I don't really have things set up the way I want anymore in terms of your will or your trust or even your beneficiaries. The most obvious examples of this, and thankfully it doesn't happen very often, but we've seen people who have gotten divorced and divorced decades ago, even, and oops, forgot to take the X off of the beneficiary form. Let's get that cleaned up before something happens. That's so extreme. It doesn't happen that often, but I have seen it before. So that's another way. Just think about that stuff. Obviously, we need to make sure your income is meeting your needs. That's one of the first things I ask people when I sit down is just, how is the cash flow going? Because that's really where the rubber meets the road, right? If you're living month to month on enough money, you're like, yeah, I'm not really having to worry about it too much. Enough's coming in that I'm able to get by every month. That's a baseline. Then we improve things even more from there. But if we're not even meeting that, okay, we got to go back to the drawing board a little bit here. And then what are your priorities this year? Again, another suit. This doesn't have to be as you know, maybe you're a New Year's resolutions type person. I'm not because I have anything against them. That's just not the way my brain organizes things. But it doesn't have to be like a New Year's resolution thing. But what would you like? Hey, we put new windows in last year, and boy, was that expensive. And we drew down our savings account by this much, and it's a little bit on the low side for what I'm comfortable with. This is hypothetical. I didn't actually put new windows in, although if I did, it probably would be true. But okay, so maybe one of our goals then, let's build that back up a little bit. It doesn't have to be all at once. It doesn't have to, we're not in trouble per se, but it's like I'd feel a little bit more comfortable if we had this number in there. Okay, that's something we can work towards. And that's something you can mention to me. And for example, I might say, well, hey, the market's kind of up right now. It's probably not a bad time to take some money out if you've got a use for it. Maybe we do that. Maybe you can kind of knock off two birds with one stone there. So make sure you're being communicative both with yourself and with somebody like me about those things. And again, you'll see the little tablet down there with the pen icon. Just not everybody is a journaler. I'm not a journaler, so if you're not, don't feel like I'm asking you to be one. But it's good to write down what we're grateful for. And, if you want to go one step further and write something you'd like to do better at, or hey, I'd like it to go differently next year, that's great. That's really helpful info for me because I can help give you tips on how to do that. Spending. Okay. So I don't necessarily think, every year you need to sit down and open up an Excel spreadsheet or your handwritten ledger and say, all right, let's budget for the year right now. Let's get it done. Some people like doing that. Some people are good at doing that, and great, more power to you. I'm not that person. I don't have a written out budget. Of course, I have the numbers in my head and, between all the different statements from things where it's like, okay, I know what's within bounds and what's out of bounds, right? And I think that's fine if that's how you are. But keep in mind that your income's going to change a little bit every year, right? One, your pension and your Social Security, if you have both of those or one of them, will go up in 2026, and we'll get to how much it's going to go up in a later slide. At least for Social Security pension goes up by 1%. But so that income's ticking up a little bit, but how much are your expenses going to go up? You can't know that in advance, but we got to start thinking about that. Was it, hey, we were getting a little tight there. Normally I'm able to live off my pension and my Social Security, Anthony, but a couple months last year, it was a little tight and I dipped into savings and I wasn't able to build that back up because the other months were tight. And I'm like, okay, well, maybe that's a good indication that we ought to start thinking about taking money from your investments to help bump that up. And you may say, "Oh no, we're not at that point yet." And okay, fair enough. But that option is out there for us to consider. And I don't think you need to be, as number two says here, compare spending patterns to your retirement budget. Just are we cash positive or are we cash negative every month? Are we dipping into the savings account every month or not? Now, and if we are, that's not necessarily a bad thing, right? Maybe we've planned on doing that. Maybe we are using some of your investments to supplement your income because that's part of our long-term plan. That's totally fair. That's not bad. But going into it with eyes open versus eyes closed is what makes the difference there. Obviously, the little tip on this slide is something we can all probably do. Are there any services you're paying for, subscriptions, streaming services that you don't use anymore? And I'm not saying cut back, but I'm saying literally if you don't use them, hey, that's found money in the budget, right? Those are always good tips to look at. All right, I'm going to get out of the way of this one. This is the most dense slide in this whole thing, so I promise this is as complicated as it gets. But we need to take a little bit of time to talk about the OBBB, the One Big Beautiful Bill Act, the OBBB, the OBBA. I think there's three B's. One Big Beautiful Bill Act. I believe that's what it's called. Anyway, that was the tax bill, among other things, spending bill, I guess you could say it was both at the same time, that passed in the summer. And it has a lot of changes to tax provisions. Now, before I go through this, I'm not just literally going to read what's on this page, although I will go through each point here. But if you would like just a one page copy of just this, we have that available. Obviously, you'll get a replay of this. Aaron can even put it in the follow up this page. But I see Aaron, thank you, has just shared it in the chat in Zoom too. So if you want just this page to get kind of your cliff notes on how taxes are changing in the next few years, this is where to go. I mean, Aaron put this together. This is a fantastic piece that really hits what's going to affect most of you. So let's go through this for a minute. All right. First off, as happens in pretty much every year, this isn't necessarily bill dependent, the standard deductions have gone up. And just to set a baseline, you may all be familiar with this, but the standard deduction, when you file your taxes, you get a choice. Either you put together all the itemized deductions you can, so what you gave to charity, medical bills, all the different deductions that you're eligible for under the tax code. You can either do that or you can do the standard deduction. You get a choice and you choose whichever one is bigger. In other words, which one's better for you. The bigger the number, the more you deduct off of your income that is no longer taxable. So it reduces your taxable income. You may have known that, but I just need to set the table. So that number, the standard deduction that we all get, has gone up again. And it tends to go up every year or most years. So if you're married filing jointly, it's gone up from 30,000 to 31,500. If you're filing single, it's gone up from 15,750, or excuse me, it's gone up to 15,750 from 15,000. And generally, as it is this year, the married number is just double the single number. That makes sense. There's two people filing taxes when you're filing as married. So that makes sense. That really wasn't part of the big beautiful bill. But the and question came in, what about married filing separately? So if you're married filing seven, I'm going to actually just look that up real quick. Sorry. Yes, 16,100 is what it's going up to next year. But it's roughly the same as filing single. It's there's those few subtle differences between filing single and married filing separately. So I can follow up on that, Aaron, if you can make a note of that so I could follow up on it. But because obviously if it was exactly the same, they wouldn't even have it as a separate category, but it's going to track with the single line there. One of the things that is new for this year, which is weird for a second. So think about that. Normally, when a tax bill is passed, they pass changes for future years. So it's like, okay, from 2026 on, here's how it's going to work, right? Well, inside the big beautiful bill were some changes that impact 2025 actually retroactively in essence because the bill was passed halfway through the year. So, one of those, and this is maybe the biggest one for everybody on this call, is everybody over 65 gets an extra $6,000 on top of your standard deduction. So you get a $6,000 deduction on top of your, if you're married, 31,500, or if you're single, 15,750. Okay. So, and if you're married, it's per person. So you get an extra 12. So really, If you're a married couple where you're both over 65 this year, not going for, I'm yes, going forward, but this year even, you will get a standard deduction of 43,500. I'm adding 12,000 onto 31,500. So that is a massive jump from what you had last year, which was 30,000 combined, right? What does that mean? Well, one, if you didn't know this, and this hasn't really been, I mean, it's been publicized, obviously, but they haven't necessarily talked about this angle of it. Most people over 65, if you got a refund already last year when you did your taxes, you're going to get a bigger one this year. Or if you owed last year, there's a chance you might not owe this year purely because of this change, this extra $6,000 deduction that, yes, does apply to 25. Now, one of the interesting things about this tax bill is that some of these provisions, and this is one of them, start either 2025 or 2026 and end in 2028. Okay. Now, so they already have an expiration date built in. Now, maybe they will end, maybe they won't end, right? You could always vote to extend them. I think that's part of what the game theory of what's going on here is. But regardless, how the law is written right now, this is only for the next, well, four tax years, 2025 tax year, 26, 27, and 28. After that, it will end. So there's nothing you need to do to get this. Like you don't have to qualify for it, but it is going to be impactful. And then there's going to be a permanent increase of deductions for of 750 for single seniors and 1,500 for married couples. So again, they're just adding on deductions for people over 65. Now, I've had when I've told this to people before, they're like, "Okay, well, what do I need to do to get this? You know, do I have to is there a special form I need to fill out?" Is no, you will just get it. Like, yes, if you're doing your taxes by hand, you're going to need to know that that rule exists, but it should be written on the 1040s. I mean, I can't speak for the IRS when I haven't seen the new 1040s for 2026, but I would imagine it's written right in there, that rule. And if it's not, certainly like your turbo taxes or if you work with an accountant, they should be aware of this. And if you want to double check, just ask your accountant to make sure they're aware that yes, it does apply to 2025. By the way, important disclaimer, I'm not an accountant. I can obviously tell you about the tax bill and how tax rules work, but I defer to their expertise on really, specific things. Also, and this one doesn't happen until next year, and that's part of the reason why it hasn't been publicized too much because it just isn't impacting anything yet. But this is actually big and maybe the second biggest item from this whole bill for everybody on this call. It's not that the tax brackets are changing, it's that the amount of dollars within each bracket is changing. Okay? Now, that might have, for some of you, I just said something that sounded close to gibberish because you're like, what? Okay. Here's how the tax brackets work. I apologize to those of you who are like, I know this, Anthony. I get it, but not everybody does. The first tax bracket, whether you're married or single, is 10%. You pay the first chunk of your income, you pay 10% federal tax on. And by the way, this is all federal so far, all federal taxes. And then the next chunk of income, and the threshold depends on if you're married or if you're filing married, filing joint, or filing single or married separately. The thresholds are half or double depending on which category or which column you're in there, but same system. The next threshold, so it's for a married filing jointly, it's about I believe it's about 10,000 is in the 10% bracket. Yeah. A little bit north of that, like 11 to 12,000. So you pay 10% on 11 to $12,000, and then there's another big jump, and it's up to like 50, where the 12% bracket goes. So in other words, let me simplify this: for $50,000 of income and under, you're paying between 10 and 12% federal income tax. Okay, hopefully you're with me so far. They are expanding beyond what the normal expansion is, the amount of dollars that can fit into the 10 and 12% bracket. Okay. And I don't know exactly what it's going to be in advance, but they've planned this expansion. What does that mean? That means more people are going to have more of their income, maybe even all of their income for the year, fall into only the 10 and 12% brackets. Okay? I know this is a multi-step thing, but I'm trying to walk through it. Okay, so if all of your income falls into the 10 or 12% bracket, the next bracket above that is 22%. So it jumps from 12 to 22. That's a 10% difference, obviously, 12 to 22%. So, hey, if we could stay under that, then none of our dollars will be taxed at 22%. That seems great. Well, what if with these expansions to these tolerance, I guess you could call it, or how much many dollars you can fit into a bracket, what if that leaves you with a gap? So not only are you under the 22% bracket next year, let's say, but you're $20,000 under it. That opens the door for many of you, most of you, to be thinking about Roth conversions. Okay? Now, Roth conversions, what is that? That is taking money from a pre-tax retirement account. That could be IRA, that could be your old deferred comp, that could be a 401k, anything that when you take the money out, it's taxed like income is pre-tax. You are eligible to turn that money, that pre-tax money, into Roth money at any time. You can do it as much as you want, whenever you want. But when you do that, you pay tax on the money you convert because Roth money is after tax and it grows tax free. So, long story short, what you're doing with a Roth conversion is you're deciding when to pay taxes on it, now or later. The conversion, that event, gives you the opportunity to say, I want to pay taxes right now because I think it's a good deal for me to pay taxes right now. Well, if for the next couple of years those brackets, that area of dollars has expanded where you're now under the 22% bracket and say, hey, if I pay taxes now, I pay 12% on my top dollar. If I wait 5 years, I'm very likely going to pay 22% on my top dollar. Well, that's you're saving 10 cents on every dollar you convert today. So filling up the bucket, filling up the bracket is a strategy we employ, where, in other words, saying, I want to make your income go all the way to the top of the 12% income tax bracket because I want to pay 12%. That's the tax. I want to pay that rate because my alternative in the future, potentially, is paying 22%. That would be the decision point. So that will be a conversation that we will have. I will bring it up to you, and Amy on our team will bring it up to you next year when we talk about, okay, let's really take a hard look at where your income is because we may have an opportunity to do this where it didn't make sense in the past. So for those again who work with us, no, it's nice if it's on your radar. Know that it's on our radar, I guess is the point that I want to bring across. But I wanted to explain that because well, it can get complicated pretty quick. Hopefully, you stuck with me on that. That's probably the most complicated thing I have to explain in this whole presentation today. So, if you stuck with me so far, fantastic. I haven't seen people dropping off the attendee list like flies, so thanks. Um, Charitable giving rules. So now we're getting into stuff that's changing next year and even the year after. Um, did you know that next year, even if you don't itemize, you'll be able to claim up to $1,000 of donations if you do donations, and that can be to, a religious organization, the food shelf. It doesn't have to be like a big, massive charity, as long as they're a registered nonprofit, 501(c)(3), it counts. And if you can claim up to $1,000 on top of your standard deduction. They added this, in my opinion, because they've kind of by raising the standard deduction as much as they have, they've kind of disincentivized giving a little bit because nobody really gets much tax benefit for it unless you're doing it out of your IRA with QCDs, and we'll get to that in a minute. But they're trying to find a way back in. So in other words, if you're donating you're walking into Walmart and you throw a few pennies to the Salvation Army. Now, yeah, you're probably not writing that off. But if you gave more, maybe you would think about doing it. So you can add $1,000 per person onto your standard deduction. You don't actually have to itemize it. Also, they're capping the amount that if you do itemize, you can write off. So you can only deduct donations exceeding 0.5% of your adjusted gross income. I could try to explain that in more detail. that's kind of a niche point for most of you, so we'll deal with that as it comes up. But they're monkeying with the charitable giving a little bit with this tax bill. Um, and in 2027, there's a new tax credit, which is better than a deduction because a credit actually just reduces the tax you pay, not just the amount of income you get taxed on, but reduces the tax you pay for approved gifts to scholarship funds. This is separate from deductions. Now, it's got it. There's like a going to be a system that registers which scholarship funds are qualify for this. So it's not like you're going to be able to say, well, my grandchild is about to go to school. I'll write him a check for 1,700 and I get a tax credit. No, it's got to be to an actually designated fund. They haven't even totally elucidated what this system is going to look like yet because it's obviously 2027. So stay tuned on that. But that could be a very impactful thing because credits are better than deductions. I'll go quickly on number three here. So state and local tax deduction. If any of you can deduct $40,000 of state and local taxes, like wow, we should talk because you've got quite the impressive real estate portfolio. But you should know, and this is one that applies this year, they have raised the cap. So right now, up till this year, you can deduct up to 10,000 in state and local taxes, right? And for us in Minnesota, generally that's property taxes. Okay, right? That's what most of us would qualify there. Most people, at least I certainly don't have state and local taxes that exceed 10,000, so that cap was never a problem for me. However, they have raised it for a limited time to 40,000, which means you can deduct the amount of taxes you pay state and locally up to $40,000. So for some of you here, you may be able to deduct more than you used to be able to. Again, your TurboTax, your accountant should have that factored in automatically. Doesn't hurt to double check. But this is not a surprise thing. Like this has been in the bill. This has been talked about. So they should be aware of it. Family and child benefits, higher child tax credit. That's if you have a dependent child living with you, it's getting bumped up a little bit, but it's the same system as it was before. Car loan interest deductions, you can deduct up to $10,000 a year in interest on new U.S. assembled auto loans from 2025 to 2028 with income limits. Okay, so if you bought a new car, especially if it was a US car that was made here, and that is a key point, obviously. Now, we don't need to get into the whole what counts as an assembled in US car because some of the foreign auto manufacturers, they ship a 90% intact car and then somebody, puts the last screw in the US and it's, oh, it was assembled here. Um, I'm not an expert on whether that counts or not. I would defer to the car companies to tell you that, but just know that that's out there. And then healthcare. Okay. Part D from Medicare, out-of-pocket costs are now capped at $2,000 a year starting in 2025. So Part D out-of-pocket costs. Okay, just to be very specific about that. Medicaid changes, there's some eligibility rules, upcoming Medicare cuts. There could be cuts to Medicare. That was part of the all the consternation that came out with this bill. Again, I could spend literally our entire time just going through this bill. In fact, we did have some reaction to it earlier in the year a little bit when it first came out. But I think numbers one, especially, and number two on this page are going to impact the most of you on this call. The other stuff, some of you it may impact, some of you it probably won't at all. So, but just to be complete, we had it in there. Okay. Moving on for a minute, and again, if there are questions about it, I'm not somebody who's read every page of the Big Beautiful Bill, so I'm working from a lot of the same resources many of you are. But I can do my best to answer questions on it. So we did have a question for the state and local tax deduction. How does someone have proof they paid 40,000? Do we keep all receipts for purchase? No. So the proof is that's the easy part for that one. That I'm literally saying the taxes you've paid and not oh, because you're talking about sales taxes. That is a good question, actually. I will have to look into that. The answer might be that they're not even sure right now because a lot of these rules get passed and then the IRS has to figure out how to apply them. That's a good one. Aaron, can you make a note of that for me? I'll double check on that one. That's a good question. What counts all for that state and local, and what do you have to keep track of? All right. So get ahead on 2026 taxes. So we just spent a bunch of time talking about taxes. So standard deduction in 2025 is 31.5. Standard deduction in 2026 is 32.2. And that also answers that question for married filing separately. That's why I got that 16,100 number. So my apologies. Because some of these tax rules got applied retroactively, it's kind of a weird thing to talk about. For 2026, the standard deductions are 32.2 and 16,100. For 2025, they're 31.5 and 15,750. So maybe that was clear to you from reading the slide, but I was jumping back and forth between years, so I just wanted to make that clear. Okay. So for 2026, then, basically, I think the thing that everybody needs to do for 2026 is get a handle on, and the best place to start is when you file taxes for 2025. What was your income in 2025? Please send us your tax return when you file, because that not only helps us figure out if you need to take money out, how to do it in the most tax efficient way possible. That's a big piece of it. But for 26 in particular, with that Roth question kind of hanging with more capacity there, that will tell us, or that'll give us a good baseline to say, okay, I think you're going to be able to do this much in Roth conversions this year. So everybody who works with us currently, we're going to be sending out notes about this. But when you file your taxes, please send them over to us if you wouldn't mind. We don't, obviously we just store them securely and run them through our system, but it really helps when you call and say, "Hey, I need to take some money out. Which account would you take it from?" Then I can look and actually see exactly what the tax impact to you will be from each different account if you have multiple. So that's a big one. A good way to do that is just obviously just make your 2026 tax folder, get that ready for when you file, and put your old 2025 return or a copy of it in there. Because last year will help inform, or I should say 2025 will help inform 2026. So boost your retirement savings. RMDs. We're coming to the time of year where everybody's RMD is going to be the big reveal of what your RMD is going to be for next year. Now, if you don't know what an RMD is, I have two things for you. One, we're doing an RMD event next month in January. So you'll get invites for that. I'll put up the questionnaire at the end if you want us to even pre-register you for that. It's all about RMDs, which stands for required minimum distributions. Two, you don't have to do an RMD unless you have a pre-tax retirement account, so deferred comp, IRA, 401k, 403b, and you're under 73. So let me say that again. If you're 73 in 2026 or higher, you need to do an RMD with those accounts. If you're younger than that, you don't need to worry about it yet. Now, that doesn't mean you don't need to think about it. We should start thinking about it, but you don't actually have to do it yet. So you know where you fall on that. But how do we maximize the amount of, or frankly, the term should be minimize the amount of taxes that you might owe on this required distribution? Because that's why they're making you do it. So we have the event dedicated to RMDs next month, which, by the way, is like one of our most popular events every year. RMDs are one of the most poorly communicated about topics from the IRS. I think it's probably because a lot of people, by the time you get to 73, you're retired. You've maybe been retired for a little while, and you're just like, oh, there's a new rule all of a sudden. Like, God, I thought I had all this figured out at this point. And so there's a little bit of consternation about it. Yeah, it's not that big of a deal. Once you do it once, it'll seem like it's super easy to deal with. But that getting over that first hurdle, that's why we do a whole event on it. So obviously, it's going to be taxed like income. So that's why we need to start planning for it. Now, more to the point, and this may not affect any one of you, although some of you on here are potentially still working, but I'm going to make a case here that you should share this info with kids and grandkids who maybe need that little kick in the pants to start saving a little bit more. These are the new contribution limits for 2026. Now, the first slide there, the first box there, 401k, 403b, 457, the limits, as you can see, are north of, especially if you're over 50, they're north of $30,000 a year, right? Because those that catch-up contribution is added on to that baseline. People ask me this. There are very few people that we work with or have worked with or have come across that are truly hitting the absolute maximum of their deferred comp savings or their 401k savings. So north of 30,000, or if they're younger, 24.5. It does happen. There are people who do it. If you're one of them, that's great. Like, it's not a bad thing. It's awesome. But don't feel bad if you're not hitting the maximum for any of you who are still working. Okay. It's not a bad thing. Few people can make their budget work while saving that much every year. I mean, that's a lot of savings if you're working and maybe have a family and all and are living life. But what, for those of you who are not working, which is going to be a fair number on this call, you already are retired. So you're like, well, I don't have to worry about contributions, Anthony, because I'm not earning any money other than maybe pension and Social Security, which don't count as earned income. Share these numbers with your friends, family, kids, grandkids. Say, hey, and I literally just did this for somebody. Send them a note and say, hey, just wanted you to know the IRA contribution limit went up from 7,000 if you're under 50 to 7,500 if you're under 50 years old. That's that middle box there. That comes out to, I did the math for him. I think it was like 41.67 a month or something like that. Comes out to 500 bucks a year extra. So ask them, hey, could you afford to save another 42 bucks a month? And if the answer is yes, then that's another 500 bucks a year, and maybe that gets them 500 bucks. If they're not even doing the maximum yet, maybe they're only doing 500 bucks to start with. But it's like, could you find another 500 bucks a year to save to this? It's 42 bucks a month. That helps to build that habit. So no, I don't think you need to interrupt, your holiday festivities. Okay, everybody, grandma and grandpa, mom, dad have an announcement here. Everybody line up and tell me how much you're saving into your retirement plans at work. No, it doesn't have to be like that. But, just if it happens to come up or if know that, hey, I heard limits went up again, and it's really not that much to go with it. Or if you just want them to talk to somebody like us. You're like, that's what I work with you for, Anthony. Can you tell them? Yeah, I'm happy to. So don't hesitate to reach out to us. We can help have that conversation. And obviously, if you're still working yourself, I would have the same conversation with you. Hey, do we have capacity to up our contribution limits? And you can see all the different thresholds there. We did get a question. Does the age 60 to 63 special catch-up also apply to a simple IRA plan? I don't believe it does. I tell you what, I will follow up on that rather than finding that answer live, so I don't take up more time, and I can make sure we end on time here. But Aaron, if you can jot that down, I don't believe it does. I believe it is only for 401k, 403b, 457. So in other words, not for SEP IRAs, SEP, self-employed person IRAs, and not for simples. But I will double check that just to make sure. It's a good question. Um, all right. So rebalance for the year ahead. If you have not talked, you don't even need to read this slide. I'll tell you exactly what you need to know. Um, if you have not talked to me or Amy in the last, I'm going to say 4 to 5 months, it's probably time for us to chat. Even if it's just a check-in, even if you're like, I really don't have anything to say. What do you guys think? And I'll give you right now a very short version of what the general advice we're giving out is. So if you feel comfortable with that, then fair enough. But obviously I can give you better info specific to you if we're one-on-one. But here's our general thinking on where things are right now. The markets have been good. The US market, the international markets have been good. In fact, one of the things we've been doing is getting a little bit more international with people over the last few months because, one, not just because they've done well, but because of some factors. And I won't get into all of the details right now. So for now, we're fairly pleased with things, actually, despite, kind of the chaos of the headlines every week. That stuff has not bled through to the markets as much as it might seem. Now, going forward, we've got some inflection points next year. And it's not to the point where we're saying, hey, everybody, brace for impact or something like that. But let me just tell you a couple quick factors. One, the market is high right now. Now, that doesn't mean it has to drop, but relative to history, it is expensive right now. That starts to make you think, well, is there going to be a pullback at some point? There may be, there may not be. That's not indicative by itself, but it's when you start looking at it. Okay, so that's one factor. Two, we have seen that the tax bill is going to probably cause a bigger refund season this year. And essentially, that's probably going to look a little bit like a stimulus check, especially if you're over 65, because you get that extra deduction on top. So that's probably good for the economy and the market, at least in the short term. However, when you get a stimulus check, inflation tends to follow behind that a little bit, right? So we're keeping a very close eye on both inflation and unemployment, as always. But if we start to see inflation ticking up in the spring, that would be a point at which we'd say, okay, now we've got another kind of storm cloud on the horizon here, and the market's already high, right? So, in essence, boil it down for me here, Anthony. It's probably you're fine sticking where you're at for now. And this is general, so I can't say that to any one of you individually without talking to you individually. But generally speaking, I think most people are okay right now, or at least if you're in a good allocation now, I don't think you need to change it necessarily. But come this spring, we should reevaluate. And that's what I've been telling pretty much everybody we've talked with. Hey, I think we're okay for now, but let's talk in the spring. And spring being March, April, around tax time, frankly, by the time the deadline is in the spring. And I think we'll know more by then. And we may not know enough to say, yes, this either it's definitely going to be good or it's definitely going to be trouble, but we should know more than we know right now. So if what I just said is like, hey, that makes sense to me, let's just talk in the spring, great. If you haven't talked to us in a while, we should. If you want to hear your specific lens on that, then that would be the reason to set up a time with us. Quickly, the Social Security cost of living adjustment, which was announced for 2026 at 2.8%, that basically matches with or is very close to where inflation is. So more or less, it's keeping up with inflation. The average person will see, and obviously none of you are exactly average. I like to think that we're all above average on this call, but that's the Prairie Home Companion line. But the average Social Security recipient will see your benefit increase by about $56. Your mileage may vary depending on what your benefit is. That's good. Obviously, the boost may be offset, and offset in the negative way, meaning eaten up by increasing Medicare premiums. And I've seen that with people who have seen their new numbers for 26 and they said, I'm not actually getting any more because it just all got eaten up by my Medicare premium increase. And yeah, usually they say that and then they kind of look at me like, is there anything I can do about that? And I'm like, no, not really. Sorry. I mean, I guess you could try to switch Medicare plans and save money, but that's generally not always a good trade-off. And there's a baseline to the premiums there anyway, so you can't get below a certain number. So it is what it is. You may not actually see an increase to your Social Security, even if it did technically increase because of the Medicare piece of it. Um, Another thing, if you have debt, now some of you on this call have debt in a good way, meaning you have very low interest debt. Maybe you refinanced a mortgage, maybe you took out an equity loan, maybe you have a car loan or whatever that's at a really nice rate. That is not necessarily debt that I'm like in a hurry to pay off, by the way. So, if you got a good interest rate, you don't necessarily need to be in a hurry to pay it off. But if you have debt and you're like, I just want to start, maybe that's my goal for the year, Anthony. I want to get more of this debt off the books, if not all of it. Let's talk about that. I'll give you some quick tips. I mean, generally, you want to pay on the debt that's costing you the highest interest rate first, which, if you have credit cards that are rolling over month to month, that would almost certainly be the answer to that. We want to pay those off quickly. A couple times a year, if not more, I have a conversation with somebody who is like, yeah, this came up and I've got some revolving debt on my credit card, unfortunately, and I want to get it paid off, but I've also got this home equity loan or a line of credit or whatever, and I want to get that paid off too. And how do I manage this? And I'm like, well, first thing we should do is, if possible, can we offload that credit card debt onto the home equity line? So in other words, if you've got capacity in your home equity line, take that money, pay off the credit cards, and now you've probably cut your interest rate in half by doing that. So again, your case by case, you may not have either of those. And if you don't have any debt, great. Then you don't even have to think about this. But if you do, we can talk about the best way to kind of shift things around and that in the way that it's going to cost you the least amount of interest over the year. It's always going to cost you something. We just want to make sure it's costing you the least it can. All right. So review your insurance, long-term care. The thing I will note, obviously, your healthcare coverage, that I think we're all fairly aware of. If it's changing year to year, or if your provider left, for example, like a lot of U-Care plans left. So if you had that, you might have been looking for a new one when Medicare enrollment was just going on here. But review that stuff. What I'll say that my little cutaway for this is long-term care insurance if you have it. Now, not probably most of you on this call don't have it, so I won't spend a ton of time because it's rarer to find these days. If you do have it though, almost every year, my guess is you're getting a letter from the insurance company that say, "Hey, your premium's going up. If you don't want that to happen, you can cut your benefits and we'll keep your premium the same or maybe even drop it." And in general, because people then send that over to me and say, "Well, what would you do here?" And in general, and again, in general, so we'd have to look at you on a case by case basis. But in general, the insurance company is offering that to you because it's a better deal for them, or at least they think it is, right? If they're offering to lower your premium, that means they think the benefits that they're cutting out of the contract are worth more than the premium cut that they're giving you. They're coming out ahead, in other words. So, unless it's like, oh, I actually could cut that and it wouldn't matter to me at all. Unless it's like that, generally you don't want to cut those benefits when they offer it to you. So if you have questions about that, let's chat one on one because I know most people on here don't even have that, so I don't want to take up too much time on it. I mentioned this at the top. Review, update wills, trust, power of attorney. Okay, you don't necessarily have to update your will every year, especially if nothing major has changed. But if something has changed, yes, we do. If you move to another state, right? Just because your desires for who gets the money hasn't changed doesn't mean that there isn't a change that needs to be documented. If you move to another state, you're now governed by different laws. So you might need to have a will that's adjusted for whatever state you're now living in, right? So that's just one example, but don't forget about those things. We can talk about charitable gifting. We can talk about your RMD, but make sure that if there's changes in your life, that the people who are helping to organize your finances are at least somewhat aware of that, because then we can give you the right advice for your specific case. 529 plans. Okay. So obviously if you have a 529 plan, you're aware of it, you're probably gifting into it. Unfortunately, there are not great tax deductions for giving money into 529 plans. You'd think there would be, right? You'd think you'd get a federal tax deduction or maybe even a credit, and it would incentivize you to give money into this. And it's really not that true. Minnesota does have a deduction, and it's capped at $1,500. So no matter how much you give, you can only deduct $1,500, and you have to itemize to take advantage of that. Remember? So that gets back to that whole itemized versus standard. So most people don't really get any tax benefit for giving to a 529, but obviously your child, your grandchild, or your friend of the family gets a huge benefit from your gift, which is they get to use the growth of that money tax free in the future. So it's still worthwhile, but I have people ask me this a lot, like, what are the tax benefits for a 529? And it's like, well, for you, not much, unfortunately. And that's just the way the system is. There's nothing we can do about it. Um, just lifestyle wise. So I'm going to take a little bit of a detour for a minute from the financial part of this. It is incredibly important to build not just a financial life, but a life that your finances fit into that you like, right? And I'm not a life coach. I'm not going to try to pretend to be here. But think of the things you can do to do right by yourself, maybe is the way to put it. And let me relate it to some stories that have actually come up. And I'm not going to take a ton of time on this, but there's somebody we work with, and she is doing perfectly fine financially. She's single at this point. She's in her 80s. So as far as we're concerned, she's got enough money to live on for the rest of her life. There's not a risk there of, ooh, we're really cutting it close here. She's got enough. And she, like probably many of you, is looking at her assets and saying, well, I just don't live an extravagant life. Like, Anthony, you're telling me to spend some of this money, but I don't know what I'd spend it on. And I'm like, okay, that's fair enough. It's not like it's burning a hole in your pocket, is what I say. But what is all this money for if it's not to make your life better? So for all of you, and everybody's got their own capacity, and everybody on this call is at their own level, wealth-wise, and every level is equally valid. Um, think about the things you could do that would make your life better. If it's, hey, I have this hobby, but I've always just kind of leaned into it, not gone fully into it because it's kind of an expensive hobby. Well, maybe we should have a conversation about that. Maybe there's a way we can fit that into a bigger financial picture. Maybe it's just, hey, I'd love to go get a massage once a week. I think that would be great, but that just feels like something that people like me don't do that. That's extravagant. And it's like, well, let's see how much it costs. Let's investigate this a little bit. One of the big ones I mentioned to people, and I think it's maybe even our next slide. Oh, it's 2 slides from now. Travel. So not just booking the trips. And hey, if you're like, hey, I did my traveling, Anthony, or I don't even have the travel bug, that's fair. You do what makes you happy. But if you do travel, and if you do already have that money in the budget, maybe there's a little bit of extra room in the budget to make your travel more comfortable, right? Or to, hey, let's instead of a 3-star hotel, let's try out a 4-star hotel. And yes, we're going to pay a little bit more for it, but let's just do it and see if it makes a difference for us. And again, this is totally case by case, but I can help you make sure that that is not going to have a negative financial impact, right? The money is there to be spent. Do things that make you happy with it. Don't blow it, and I'll help you not just blow it. I think that's one of the things people worry about. It's like, yeah, but if I open those floodgates, Anthony, then I'm just going to start blowing money on stuff I don't really need. I get that, but I'm here to help you make sure we're doing it at a reasonable pace too. Obviously, another big source of financial, well, sometimes stress, hopefully not too much stress, but it's taxing on your finances is if you're doing home renovations, if you're doing landscaping, those things are expensive these days. I mean, they've always been, but even more so now. Um, but we can figure out a way to make that work. And if you have a big purchase that you're planning on coming up, talk to me or Amy about it, and we can say, hey, okay, you could afford to pay cash for this, but actually, what I want you to do is go talk to a bank and let's see what interest rate they'll give you. And then we can kind of shop around a little bit. So you may know all that. That may have been in your head already, but I try to re-emphasize it because the money is there to be used to make your life better, more comfortable, help your friends and family, all that stuff. It's not just there to look nice on your statement when you get it every quarter and say, oh, I can exhale because there's this in there. That's supposed to be for you on some level. So let's figure out how to do that. All right, off my soapbox here. I'll leave you with, and then we'll open it up for questions. Now, I should do more homework on this because this could be something that, you just see on a panel or something and it sounds true, but it may not be. But I was watching, it was a video, but there was a panel and I don't remember what conference it was at or whatever, but it was, kind of like a self-help person, so to speak. And generally I don't watch a ton of that, but they were talking about what are the most important, let's see if I can remember this. I believe it was what are the most important organs or parts of your body for longevity, for living a good life? And that's what the person was asking the other person. And the person was like, well, heart, brain. And he's like, yep, those are the two most, actually, I think it was heart and lungs were the first two that they mentioned. Like if your heart's strong, if your lungs are strong, that's a great indication that you're going to live a long and happy, well, happy is a whole other ballgame, but a long and thriving life, at least physically, right? But the third piece, and this goes to the more psychological part of the equation, that he said are your thigh muscles, which I wouldn't have thought of, right? And the point is this: your thigh muscles or your leg muscles are what allow you to move around the world. It's what allows you to go see people, to walk over to the store down the street and pick yourself up something, or to just get out of the house, period, and go do things. And that is so impactful for mental health that is one of the most important factors as we get older for keeping ourselves happy and thriving. So don't neglect that stuff. Again, I'm not a doctor, I'm not a self-help person, but that always just struck me when they said that, how important that is, and it makes sense to me. Like I totally believe that that could be true. So that's what I'll leave you with. Best ways to get in touch with us. Our contact info is on the screen. That connect email address goes to myself, goes to Aaron. So we see everything that goes in there. You can certainly email me individually as well, or Amy or Margie, any of us, and we'll make sure you get your question to the right place. By the way, I mentioned it before, but I should say it again. Our next event next month is RMD specific. So from the basic of how RMDs work to how do you give to charity out of your RMD? How is it taxed? How do you potentially minimize it? Or what should you use it on? All that stuff is what we go over next month in January. And of course, you'll all get invites for it besides. So I think there's time. I can get the answer to whether the simple IRA has the same limit or those same. I'll go back to that slide. The it was here. Whether it has the same catch up, that special 60 to 63 catch up limit. Okay, so they do not, based on the they do have special catch-up limits, but it's not quite the same as for 401k and 403b and 457. They are, let's see. If the plan opts in for simple plans, the standard catch-up age 50 plus in 2025 is 3,500. The 2026 is 4,000. But the age 60 to 63 special catch-up is 5,250 per person. So it's not the same as for 401k, 403b, 457, but they do technically have one. Yes, thank you. Amy put that in the chat too. You probably had that before I was reading it. Thank you, Amy. Um, and those are the numbers for 2025. Is the regular catch up is 3,500, but they do have the special catch up, which it goes up from 3,500 to 5,250, essentially. So no, to make it even more complicated, probably than it should be, frankly. But all right. Any other questions for us? Otherwise, feel free to take off. We're at time. I appreciate everybody being here. By the way, we are going to try to mix up the day and time a little bit more. We've gotten some feedback from some people that like, hey, you tend to do these at noon, and that doesn't always work for me, especially on Wednesdays. So we'll mix it up a little bit. We've done that in the past too, but give us that feedback if you have it. Like, actually, Anthony, please keep it at this time because that's the only time that works for me. We that feedback is important. So. I don't see any other questions. So thank you everybody for being here. We will talk soon. I hope you have a great holiday season here. Thank you.